If you're truly watching what's unfolding right now, you already sense that we're approaching something that doesn't fit the definition of normal, and not in the casual YouTube sense where everything is labeled massive or crazy, but in a far more uncomfortable way that forces you to confront the possibility that 2026 is shaping up to be either the quietest year modern finance has ever experienced, or the year that completely blindsides hundreds of millions of people who still believe the system is fundamentally stable. There is no realistic middle ground here. The signals are too persistent, the capital movements are too synchronized, and the messaging coming from Wall Street, central banks, and crypto infrastructure firms is far too aligned to dismiss. The reality is that most retail investors are missing what's happening directly in front of them. Just look at how frequently Federal Reserve leaks are appearing. Every single week there are carefully worded hints about rate cuts. They're framed as recalibrations, policy tweaks, or economic support. This is not accidental. This is how institutions prepare one another for coordinated rotations back into risk assets. At the same time, we are witnessing a wave of crypto acquisitions. These are not rumors, they are not speculation, they are not hype. Real companies are buying real businesses with real capital. That signals consolidation, not disorder. And consolidation always comes before major structural shifts. The same themes keep repeating: tokenization, custody, treasury frameworks, institutional infrastructure. These are no longer buzzwords. They have moved into active implementation pipelines. Large firms are no longer debating whether to participate. The discussion has shifted to how to position before broader awareness sets in. If that sounds exaggerated, look at the capital projections released toward the end of 2025. No one is guaranteeing that outcome, but the fact that it's even being modeled tells you how much the landscape has changed since the last cycle. What many people still fail to grasp is that none of this is happening in isolation. The most boring headlines are where the real transition is hiding. Corporate Bitcoin demand is expected. Ethereum being treated as a yield-generating institutional asset is predictable. But beneath all of that is the steady emergence of treasury strategies being designed specifically around XRP. Not someday. Now, companies are preparing to allocate hundreds of millions. Funds are being structured with XRP as a reserve component. Ripple is positioning itself like a future BlackRock-style entity in digital finance. It is doing this by acquiring firms that enable custody, allocation, management, and scaling of institutional capital across crypto. These signals are not random. They are not algorithm-driven headlines. They represent coordinated infrastructure development. They directly contradict the idea that crypto is stuck in a temporary hype phase. These organizations are preparing for a world where digital assets are required components. Meanwhile, the average investor still assumes the market is just consolidating or taking a pause. The uncomfortable truth is this: if 2026 ends up being exceptionally quiet, it won't be because nothing is happening. It will be because everything is unfolding behind closed doors, quietly, methodically, intentionally. And if it erupts all at once, those who ignore these structural signals will be left staring at charts wondering how they missed one of the largest shifts in financial architecture ever. Acquisitions, treasury strategies, and institutional alignment are not noise. They are the early stages of an entirely new market structure. If you're still analyzing crypto through a 2020 or 2021 lens, you are already behind. Narratives used to move money. Now money shapes narratives. Large players are no longer reacting to markets, they are engineering them. XRP sits directly in the center of this transition, whether retail recognizes it or not. Even rumor cycles reflect this shift. Take the talk of Ripple potentially buying back XRP. Many dismissed it as a meme. Few analyzed the mechanics. The idea wasn't about hype. It was about treating XRP like undervalued equity, repurchasing a scarce asset when long-term value is better understood internally than by the market. That aligns with corporate logic, even if nothing has been confirmed. This mindset reflects institutional thinking, not retail speculation. The bigger story is what's happening behind the scenes with Evernorth and the formation of $1 billion XRP treasury. This is not driven by influencers. It is not driven by small funds. It involves entities tied to SBI in Japan, one of the largest banking groups in the world, alongside players like Panta Capital, Kraken, Chris Larsen, and GSR. These are not casual participants. They understand liquidity dynamics. They understand systemic flows. They understand macro-driven capital shifts. A billion-dollar XRP treasury is not built for short-term price action. It is built because XRP is viewed as long-term financial infrastructure, comparable to a reserve component in a global settlement system. That is why these firms are choosing structured treasuries instead of allocating to low-utility tokens. Treasury formation is institutional behavior. It targets predictable liquidity, yield, and appreciation. This is also why Ripple's acquisitions are not random expansion. They are strategic absorption of custody, settlement, and enterprise infrastructure. The goal is vertical integration, similar to what BlackRock achieved in traditional finance. That only happens when a company is positioning for a decade where digital assets are foundational, not niche. When you add yield into the equation, the picture becomes even clearer. Companies are no longer just holding crypto. They are designing balance sheet strategies around it. Ethereum staking demonstrated consistent yield. Bitcoin protocol showed income generation without staking. Now Flare is emerging as a yield engine for XRP. Staking generates revenue. Treasury desks care about that. CFOs do not ignore scalable yield. This is why 2026 is a pressure cooker. Rate cuts restore liquidity. Institutions search for growth assets. Regulatory clarity improves. Crypto infrastructure matures. XRP is not being positioned as a speculative trade. It is being positioned as long-term architecture. Retail investors still treat it like a simple position. Institutions are playing multi-year chess, quietly placing pieces, long before the public notices. By the time these connections become obvious, early positioning will be gone. Supply dynamics matter more than headlines. Price moves are driven by supply and demand, not tweets, not rumors. XRP's circulating supply structure was designed for institutional flow, yet the effective float is shrinking through concentration. Fewer wallets control more supply. ETFs and treasuries remove XRP from circulation for years. That creates conditions for sharp repricing, not gradual movement. Even buyback rumors fit logically into this structure. Aggressive absorption tightens liquidity. Exchanges are forced to reprice. This is how supply shocks work. Chart behavior reflects this. Long consolidation under resistance is not lack of interest. It is liquidity migration into long-term holdings. Institutions absorb supply quietly, on low-volume days, without chasing. The truth is simple. Moves to higher price ranges do not require magical events. They require imbalance. That imbalance is forming. Retail waits for headlines. Institutions read balance sheets, escrow schedules, and wallet concentration. Zoom out far enough and it becomes clear. XRP is not competing with meme coins. It is moving into critical financial infrastructure. Bitcoin has been institutionalized. Ethereum is middleware. XRP is becoming settlement and treasury infrastructure. That changes everything. Valuation frameworks change. Cycles change. Expectations change. Institutions do not operate on hope. They operate on models, yield expectations, integration strategies. That is how XRP is being treated. In a future where digital value transfer is standard, XRP's role expands. Ownership concentration matters. Early holders represent a minority position in a future system. Most of the world enters later, when infrastructure is complete. When prices reflect scarcity, wealth is not created by reacting. It is created by identifying structural shifts early, staying positioned while others debate. If XRP ever reaches extreme valuations, it will not be because of hype. It will be because supply was absorbed by entities that understood its purpose. Late entrants will not accumulate meaningful positions. That permanently changes ownership dynamics. Step back far enough and the pattern is obvious. Nothing happening now is random. Nothing is temporary. This is coordinated transformation. It becomes obvious only in hindsight. The real question is not whether 2026 will be explosive or boring. The real question is whether you are positioning ahead of structural change or waiting to be told what already happened. Billion-dollar treasuries signal commitment. Infrastructure acquisitions signal vertical integration. Structured strategies signal institutional normalization. These moves are not designed to impress viewers. They are designed to secure liquidity, manage risk, Embed XRP into digital finance. Retail underestimates institutional accumulation because it happens quietly, through frameworks, custody, compliance, yield planning. Those frameworks are being built now. The window to accumulate meaningful XRP is not infinite. Shrinking float and institutional lockup will force price discovery. Markets move quietly, then suddenly. Most people understand only after the breakout winners identify setups early, not late. This is one of the most pivotal setups in XRP's history. Discipline matters, planning matters, risk management matters. This is not a lottery ticket. It is a strategic position in a rapidly evolving financial system. And as always, this is for educational and informational purposes only, not financial advice. Do your own research. Assess your own risk tolerance. Never rely on a single source when making financial decisions.